editor-in-chief of Jing Daily, which is a digital publication specializing in the field of the Chinese luxury market and culture and how the two intertwine in the greater China market, essentially. We were started in 2009, and we updated daily, and so I encourage you all to check us out. What I'm going to go through is very briefly kind of give you a quick overview of the sort of current state of the Chinese luxury market and what we're really keeping an eye on this year as it develops and changes along with the consumer. So currently, for anybody not really following the Chinese luxury market, at the moment Beijing is really cracking down on government officials and wasteful spending and corruption, right? And it's very highly publicized. And so what a lot of people in the luxury business are wondering is if it's going to hamper the sort of rebound of the luxury market in that country, which has been growing at double digits for the last several years and dropped down to about 9% last year. So we don't actually think that it's going to, cause the whole luxury market to fall apart or anything like that. I think it's going to be a very subtle shift. But what's going to happen is we're going to have winners and losers this year. And what's happening is that kind of the very big logo brands, logo-led, logo-heavy sort of clothes and handbags and things like that will probably lose out this year, as will sort of first-tier cities, brick-and-mortar stores. Also, watchmakers are a big sort of losing market this year as people become much more conscious about showing off their watches in public, especially government officials. Baijiu brands, which is a sort of if you don't know, it's sort of the Chinese, whiskey moonshine kind of thing. It's very expensive, and now that they're cracking down on very lavish banquets, that's going to lose out as well. As are ultra-luxury automakers in some cities. We're going to probably not have a whole lot more of these, dragon-covered Ferraris this year in China selling. And domestic realtors will probably lose out as probably becomes more difficult for government officials in particular to buy. But who will win this year is, as the consumer develops, they're going to be continuing to focus more on low-key, lesser-known luxury brands. So finding niche retailers, finding niche designers. They're also going to be shopping more at multi-brand retail stores, trying to find new designers, trying to find new brands that their friends haven't heard of, that they haven't heard of. And e-commerce is going to win as well. Winemakers are going to do quite well this year, especially in certain cities, second and third tier cities, as people kind of turn more towards wine for health benefits and things like that. As are duty-free, as Chinese tourists increasingly go out into the world. And overseas realty, something that we definitely see in New York City. So one of the big questions that we're watching this year is whether luxury e-commerce, which was a big boom last year in China, will really live up to its potential this year. China is expected to become the world's biggest luxury e-commerce market and e-commerce market by 2015, if not before. But the problem is that we have tons of different retailers rushing into the market. A lot of them are really unproven and kind of brand new startups. So we don't know who's really going to win. Some of them are kind of leading the way. So like 360 Buy is one that just got a big injection of capital. And in addition to that, we have a lot of international retailers like Neiman Marcus, like the Outnet, like Yoox, that have kind of gone into the market in the last year. So what's happening now is it's really kind of splitting in half. So on one side you have full price retailers like Neiman Marcus who really are pushing exclusive collections, higher priced items. And on the other side you have a lot of domestic retailers that are really pushing low margin, deep discounted items. So it's really splitting in half at this point. We don't know who's going to win in the long run. But what's interesting is that the consumers, based on where they live, are buying different stuff. Top-tier consumers are more interested in the full-price items, especially for brands that they can't get readily in their city. Whereas people in second- and third-tier cities are more cost-conscious, price-conscious, and they're often going for the domestic retail companies. Women are more interested in general in buying apparel and cosmetics online, whereas men are more interested in researching and buying things like watches, big-ticket items. But the key in the China market is really that people demand, they don't just expect perks, they really demand them. And especially for, international retailers can get away with a little bit less, but domestic ones really have to push to offer lots of tailored services for the Chinese market. Things like same-day shipping, easy returns, authenticity guarantees, Some of them are even sending consultants to your house to style you. It's becoming almost like a war to offer the most perks. So this is something that we're really watching this year. Yet, in a race to the bottom for the domestic retailers, yeah. But it's funny that that it's a race to the bottom for prices while also racing to the top in terms of perks and tailoring services. So it's really strange. It's really hard for these companies to make any money, and a lot of them aren't making any money. So a lot of major brands, individual brands, are very reluctant to sort of dig in to the Chinese luxury market, the luxury e-commerce market, kind of preferring to stick to multi-brand e-commerce sites like Neiman Marcus or Yoox. So that's something we're really keeping an eye on this year, to see if more brands, in addition to Coach and Zara and fashion brands, really go in on their own. Another big trend this year is that social media is really here to stay. Last year, people were saying it's kind of a trend. Brands were really digging in on especially Weibo. But this year, people are going more into WeChat or Weixin, which is still sort of in the experimental stage for brands. You see Cadillac on there, you see Coach, you see Louis Vuitton, but there's not a whole lot of brands using it. And WeChat, for people who haven't used it, is it's really quite similar to WhatsApp and a few other services where it pushes out messages, short messages to people who opt in to follow you. So brands are using it for announcing store openings, for promotions and things like that. Weibo right now has about 400 million users. Actually, it's closer to 500 million now. And pretty much every luxury brand has a presence on there. But the key this year to watch is WeChat and other mobile apps, because PC use is way down in China. Mobile use is way up, especially for younger consumers. That's how they get their information. That's what they look for first, is mobile. So the key this year that we're really watching is mobile payments, which Weibo and WeChat are rolling out now. So whether brands will actually start selling stuff on their social media platforms is the big question. The other really, really big story this year is the outbound Chinese consumer. It's continuing from last year and the year before. So we're seeing a lot more Chinese consumers going overseas to purchase luxury items because they're much cheaper than they are at home. You get a better selection, you get better customer service generally. And so it's really kind of going in two directions as well. The kind of really elite consumer is still going to Europe and increasingly going to Europe, whereas the middle class from second and third tier cities is going to Hong Kong, where the elite used to go to do their luxury shopping. So this is, where does this leave the mainland Chinese market? Well, the short answer really is that it leaves it in a bad spot. Serious tax reform on luxury taxes that make prices about 40% higher in the mainland than Hong Kong are really unlikely this year. The government often says, oh, we're going to lower the luxury tax, but they never really do anything about it. So the price increases that brands are doing in Europe aren't going to really dissuade anybody. If they raise prices 15% in Europe, it's still 25% cheaper than it is in China. But they're raising the prices in China as well, so no one's really going to be shopping there. Customer service lags behind in China, and so we're going to expect to see the really wealthy, really top-tier consumers keep going to Europe and the US, whereas the middle class will go to Hong Kong. So that's my speech. It's a very brief overview, and I hope you'll check us out, genedaily.com, and if you got any questions, just let me know.